The Reserve Bank of Australia has chosen to leave cash rates unchanged at 3.5% for the third straight month. In his statement, RBA Governor Glenn Stevens referred to a softened world economy. Joining me on the phone now to discuss this decision is Kara Ordway from City Index Sydney. Kara, the RBA's choice has met with market expectations, but could you just briefly talk us through the economic sentiment surrounding this decision?
Well, there was actually some speculation that rates would actually be cut today, and there was a probability of around 25% in some instances. So this wasn't a dead certain today for many economists or traders in the market. But the main comments coming from Glenn Stevens were that the rates were at an appropriate level at the moment, and his justification was largely centred around growth rates remaining close to trend, inflation widely expected to remain within its target, and Australia still having relatively low unemployment rates compared to the rest of the world. He also talked about consumption remaining firm within the economy. However, as he said, the big difference this time within those comments came from the distinction he made with China, and particularly this distinction between the first half of the year and the second half of the year. Now, he particularly said that prospects for China may be fading going into the second half of 2012. And we do know we have seen that within the rest of the global economy in terms of a different market between the first half and the second half of this year. So really that is going to create a lot of uncertainty for the Australian domestic economy in terms of near-term growth for the region. But what you have to remember within the Australian economy is that we have seen 4 rate cuts in total since last November. Now, this is largely in anticipation for global woes as a knock-on effect from European woes and also the slowdown in China that he has mentioned. So this has been put in place as an insurance for these types of concerns that he has mentioned today. So I think at the moment those comments kind of surround the appropriateness of the current rates that we hold at the moment.
Glenn Stevens also noted in his statement that some commodity prices of importance to Australia have fallen sharply in recent weeks. The terms of trade peaked a year ago and have declined significantly since then. While the RBA has suggested that interest rates could remain unchanged for the remainder of the year, could the rapidly fading mining boom prompt sooner action? Some traders have their eye on October for a possible rate change.
Yeah, well, a lot of questions will be answered this week with growth figures out and unemployment figures also out. With regards to the biggest concerns surrounding rate cuts, as you said, this will obviously be commodity prices. The sharp falls that we have seen in the past couple of months and even weeks will have a significant effect on not only the Australian dollar but the economy as a whole. Iron ore prices are half what they were a year ago, and as you said, this has also meant that the terms of trade have been looking a lot more worse for wear in recent times. And this has resulted in a fairly bad month for August in terms of economic data. So now what we are looking at is around a 60% chance of a rate cut in October, and many economists are actually expecting December or the end of the year to hit 3% for the rates in the Australian economy.
The Australian dollar rebounded from a 6-week low following the rate decision. With exports up in the second quarter, is the issue of a strong dollar still a concern to the RBA? And what can we expect from the Aussie dollar over the coming months?
The Aussie dollar has actually remained largely robust in the past couple of weeks, despite those falling commodity prices. I think a lot of traders and economists have been preoccupied by worries elsewhere in the global economy rather than what we are seeing in the domestic economy here in Australia. But what we might see is the Australian dollar play catch-up to these falls in commodity prices, and it certainly does have the potential to head lower in the coming months towards the end of the year. What will be a big factor in the Australian dollar and where it goes will be what we see happening within Europe and the US in terms of their central bank decisions and what the economy is doing there. What we do know is the Australian dollar is a risk currency, so when it does move, it does tend to move very fast. So it certainly could be an interesting last quarter, and certainly that parity level may be on the cards if we do see some big movements in the market and continual global concerns.
Lastly, Kara, can we expect tomorrow's GDP figures to support this decision?
Well, GDP figures have often been a bit of a surprise in the Australian economy. We had those very high first quarter figures that knocked a lot of those doves in the market off their chairs when it was announced. So there's always a potential for a surprise. Obviously, Glenn Stevens today was talking about the expectation of growth to remain on trend, and so my estimation is that they should be in line. We're looking at about 0.8% on the quarter and around 3.7% on the year. So all in all, fairly good numbers compared to what we are looking at in the rest of the world, in particular Europe and the UK and the US. So I would have thought largely in line tomorrow.
Kara Ordway there, speaking to me direct from Sydney. That's all we've got time for right now, but for all of your technical analysis and exclusive interviews, stay tuned to Dukascopy TV.